So a CEO walks into a boardroom and says, I have some good news and some bad news. What do you want first? Anyone? Okay, you like me, okay. The bad news is the number of new deals we've signed this past year continues to slide. The good news is the average deal size is up. So if you are the eternal pessimist like me, you'd focus on, obviously, the number of new deals sliding. But if you're an eternal optimist, like all of our CEOs in this room, you'd focus on the average size deal. Well, we've observed the same things inside of venture this past year. And the question is, who would be right? Is the business strong or is it sliding? We're going to share some stats with you and let you be the judge. So yes, the number of new deals did slide last year, but only marginally compared to the year before. It's a trend we're watching closely this year, but on the flip side, there was over $85 billion that was invested into venture this past year in North America. That's the most we've seen since the year 2000. And while the total number of deals was down 8%, the average deal size was up 12%, and the trend continues. So we always ask our companies, guys, can you please break things down into cohorts or segments? Give us a better view on what's happening at a more macro level or a more micro level. And we did just that inside of the tech sector. IT investing still remains the most significant category in venture. It represents a third of overall VC funding. And interestingly, while the total capital flowing into venture was up 12% last year, in IT it actually slid 10%. This was mainly reflected, as you can see, in later stage deals going down, and the average size of later stage deals going down. But last year, mid stage or the early stage, they actually went up. But after all this, the tech sector hit blast off in 2018. This past quarter, 75% more capital was deployed into the IT sector than in Q1 of 2017. The average capital invested in early and later stage tech deals has grown considerably. And while smaller deals didn't quite reach their levels of Q1 2016, they're up a little bit over Q1 2017. But most significantly, and you can see it in the blue and the gray graph, is the volume of mega rounds from this past quarter. Uber, Lyft, Magic Leap, Katera, DoorDash, they collectively amassed $4.7 billion of new capital this past quarter. There were 14 other companies that raised $100 million or more in the first quarter of this year. There was only one company last year in the first quarter that raised $1 billion or more, and there were 0 in Q1 of 2016. Coincident with this, valuations started to increase as well. So I bet you're wondering, why is this happening? Good news is I'm going to tell you. Okay. First and foremost, capital flowing into this asset class is at an all-time high. We did observe in 2017 that there were far fewer seed funds that were raised, but if you account for the fact that SoftBank announced and raised and started to deploy a $100 billion vision fund, it's the first time where we've seen capital raised exceeding capital deployed. Also significant, and I mentioned this before, SoftBank's $100 billion fund has already started being deployed. They've deployed a third of that capital already. They've wrote outsized checks into Lyft, Uber, WeWork, amongst many others. And as we look towards 2018, there's been a very strong response from the Sand Hill Road establishment, Norwest, General Catalyst, Battery Ventures, Khosla. They've all raised billion-dollar-plus funds. Sequoia is targeting a $12 billion-plus fund. And they're all positioning themselves as stage agnostic, meaning they invest in the seed and they buy up in later rounds. That's completely in contrast to our existing model, where we take early, large positions in anticipation of future round dilution. Now, as I mentioned before, the total number of deals are down in basic economic terms. That represents decreasing demand. you see that these mega funds are being raised, representing an oversupply of capital. So naturally, that puts upward pressure on valuation and in turn check size. And we expect this to continue for more mature transactions throughout this year, and will likely have an effect and a trickle-down effect into the earlier stages, as well as down into the seed stages as we move towards the end of this year. And speaking of large sums of money, let's talk about money in the digital form. Now, we all collectively held our breaths years ago when large crowdfunding sites like Indiegogo and Kickstarter emerged as alternative forms of raising early-stage capital. But in late 2016, when ICOs emerged as an alternative form of mega-sized deals, we saw the impact that this was having on traditional venture capital. In particular, CEOs were accessing large pools of capital with very limited or no governance. Whoops. There's been $10 billion in proposed ICOs already this year. That's up from $4 billion last year and $300 million the year before. What a rocket ship. So that's a lot of capital. There's been a lot of proposed projects. Who here, has anyone here participated in an ICO? That's too bad, because I had a Bitcoin for you. John, you did? Oh, yeah. Excellent. And it's also what I thought, because the majority of ICOs are funded by investors living outside of the Western world. These people have mined large pools of Bitcoin and Ethereum and are looking for alternative financing opportunities and what they call liquidity. And while the majority of venture rounds are fully funded or oversubscribed, can anyone guess the number of ICOs that have either been fully funded or oversubscribed? Come on, guys, let's go. A little bit of interaction here. Our ICO expert, John, what do you think it is?
Over 100.
You think over 100? Oh, then you'll be surprised to find out it's 27%. So 5% have been oversubscribed, 22% have hit 100%, 73% remained undersubscribed, and the average proposed size of an ICO, $31.5 million. That there is putting pressure on Series C and later financings, and that's why we're seeing also increased size of financings. And so, while the majority of our financings and financings in the venture community are fully funded or oversubscribed, you can see why there's a lot more money that's being being poured into this category. And while we as venture investors, by definition, take on high risk investing, we think that tokens have extreme volatility. They have weak security protection, and most importantly, their float value is almost impossible to predict. So we talked about the availability of traditional capital. We talked about the availability of alternative forms of capital. The real question is, where's the money going? And it's to fight the 800-pound gorillas. Okay, so the next question. Can anyone guess how much Facebook, Amazon, Apple, Microsoft, and Google spent in 2017 on R&D? Okay, come on, someone.
20 billion.
20 billion? Did I hear 20 billion? 100 billion, okay.
27 billion for Apple alone.
Oh, we have an Apple expert in the crowd. $71 billion, that is twice the amount that was invested in venture IT last year. And by the way, it's 25% more than they invested the year before. Whoops. So these companies are all investing in products that are inside and outside of their core competency in their core markets. And that's part of the reason that good ideas in venture quickly become great ideas, and the capital flows back to these great ideas to help accelerate growth even faster. But their focus on engineering talent, both with specialized backgrounds in both machine learning and AI, are really making it very difficult for companies at the earlier stages to find great engineering talent. And it's not just a shortage of engineering talent and product talent that's impacting recruiting efforts. Across the board, in the US and Canada, unemployment rates remain extremely low. Technology company efforts to recruit talent from abroad, particularly in the US, have become increasingly difficult because of the foreign visa ban. And while the entire workforce isn't employed by technology companies, it's definitely having a substantial impact on startup compensation. We looked at 5 major venture markets and observed over the past 4 years that the average salary is up 5% annually. The challenging recruiting environment, the increases in compensation, they're both contributing to the need to raise additional capital. And recruiting isn't the only issues that companies are facing today. Outside of Instagram, which is a relative newcomer into the ad market, if you look at Google and LinkedIn and Facebook, prices are skyrocketing for customer acquisition. Now, companies are keeping their blended acquisition costs low, but they're still raising extremely large war chests to fight against the behemoths and to continue their aggressive growth rates. And finally, with reference to growth, tech companies continue to favor growth over profitability. Since 2013, newly minted companies have been trading off profitability for aggressive customer acquisition and product expansion. Only 17% of these companies, tech IPOs, reported positive earnings this past year. 17%. Has anyone heard of Uber? Okay, this is interactive, people. And if you haven't heard of Uber, we've got a problem. Okay, I'll assume you all have. They lost $4.5 billion last year. WeWork lost $1 billion last year, and Snap lost $3.5 billion in its first year as a public company. It's trivia time again. Okay, can anyone name the 1980 unicorn? I will help you out. It wore a mock turtleneck. Oh, Elaine, congratulations. Apple Computer went public at a $1.5 billion market cap. And guess what? Apple Computer was profitable, just like 90% of its peer group in 1980. Today, that company has close to $1 trillion market cap. That is one fat unicorn. Now, in contrast, Dropbox went public at $9.1 billion, Spotify at $30 billion, and they were not part of the 17% that were profitable. Both of them were not profitable. Talking about IPOs, let's take a look at the M&A environment. Now, total venture-backed volume for M&A is down. Average price is up a little bit. This doesn't surprise us, it doesn't concern us because of the availability of capital that we talked about earlier. Now, there's been this clear strategy from the 800-pound gorillas that I mentioned in the past for acqui-hiring. That's transitioning. Microsoft, Cisco, Amazon, Intel, they've all led multi-billion-dollar acquisitions in the last year, but they've been focused on large companies that are revenue accretive, and they're looking to diversify their current products. Conversely, if you look at Alphabet and Facebook, who've traditionally been high-volume acquirers, they've seriously slowed down their M&A pace over the last 3 years. And now let's look at the exit timelines. We talked about the availability of capital. We touched on the fact that it's pushing valuations up. We also talked about the fact that our entrepreneurs are favoring growth. And we observe here that larger dollar exits are requiring prolonged hold times. And they seem to be going up. But here's why all of this matters. We believe it's worth the wait. Our fund drivers are well positioned in the current market environment. You'll be hearing from many of them after me. They're all considered leaders in their respective markets. They all continue to grow aggressively, and most importantly, they're all well capitalized to maximize our collective returns. So where are we headed as a fund? I've talked a lot about that competitive market. It's flanked by these behemoth funds, and it's flanked by these outsized investments. How does a $150 million fund compete? Well, I'll tell you, it's absolutely not simple. But over the past 10 years, we've honed our craft at identifying seed deals. We invest a small amount of money early for a large position, and we spend a large amount of time with the founding teams and the entrepreneurs with an eye towards leading or co-leading their Series A's. And the strategy, I'm happy to say, is paying off from both a deal flow and value perspective. In Fund 2, we did 17 seed deals, 8 of which have exited, and 8 of which have gone on to grow and continue to grow. We've managed to preserve our high ownership while maintaining the lowest average cost for preferred equity on the cap table. The strategy also remains consistent with Fund 3. We've converted 7 of our 15 seed deals for a total of 11 Series A deals. To demonstrate how this strategy's paid off, we've completed 10 follow-on financings this year. Last trivia question. How many of these had a seed entry point for Relay Ventures? There are 10 up there. Okay. Well, I'm sad to say no one's walking home with some watermelon seeds. You're all close. You're all close, but it was only 9. Who said that? Oh, you weren't loud enough. And the good news is you don't have to take these over the border. Okay, but these companies, most importantly, collectively raised over $300 million of capital in the last year. And that past year is since our conference last year. So we've stayed disciplined and we've remained committed to backing our winners. We've participated in each of the subsequent financings for each of these companies. Now, if we could sprinkle a little magic pixie dust on the portfolio, we would love to have enough capital to exercise our full pro rata or super pro rata rights in every single one of these. And these investments are all a product of our investment thesis from 10 years ago. We started the fund around the concept that mobile would be your entertainment device, your wallet, and your personal productivity tool. And that's when there were just 2 million smartphones in the market. And then smartphones represented this platform shift from the BlackBerry to the iPhone and Android. This all triggered the move from desktop to mobile as a center of technology. And it's not just us in the room who believe it. There are 2.5 billion people in the world who have a smartphone. And they're becoming ubiquitous, or they are ubiquitous. And manufacturers are pushing to out-innovate themselves. Chipsets are far more powerful, battery power has been optimized, and the sensors in your phone make it smarter than your laptop. These sensors are enabling new features and services on the device, but more importantly, entrepreneurs are unbundling these sensors from the phone itself to create a whole new set of devices and applications. And it's more than just taking a commodity smartphone component and wrapping plastic around it. It's about a whole new context. We're talking about sensors in the wild, on your body, in your car, in your home, in the enterprise, or even in space. We're also talking about new forms of processing power on the device with machine learning capabilities where algorithms collect, analyze, and deliver insights on vast amounts of new data. Simultaneously, computing is being miniaturized. It's moving to a small screen or no screen at all. So our DNA remains mobile, but mobile is no longer just about the phone. We're entering an era of cognitive systems where hardware and software will learn, adapt, and sense, just like humans. And this is fundamentally changing the way we move, we interact, we learn, we live, and we work. We had conviction 10 years ago, and nearly half of the 2.5 billion smartphones worldwide run with software from a Relay portfolio company. Imagine a world where Relay finance companies power trillions of connected sensors for billions of people. Thank you.